Hi everyone, in this video we're going to be looking at Chapter 1, and in Chapter 1 we will be reviewing the concept of financial statements, the foundations of accounting, and putting that in a perspective of personal accounting. Primarily we're going to pivot into more of a business focus with business accounting starting in subsequent chapters, but our text begins with personal accounting so that you can connect some of the concepts that we discuss a little more easily to your own life and maybe make this a little bit more personal and understandable. And then we will, like I said, pivot into more of a business focus as we go forward. Okay, so we're going to begin by talking about the purpose of accounting in general. So when it comes to accounting and what is accounting, what we're talking about is a system or a methodology for identifying, measuring, and communicating financial activities of a business, both from a perspective of what kind of assets does the business own, what kind of liabilities does the business have, what is the net worth of the business or the individual. Sorry, I should mention, put this, I guess, in context of personal. And these concepts can apply, like I'm alluding to here, both in a personal context. We all have our own financial information. We have debts or liabilities that we might owe. Maybe you all have some student loan debt, for example. Maybe you have cash in a bank account, a checking account, or some savings. Those would be assets that you own. And if you were to take all of your assets and pay off all of your debts, that would be the concept essentially of net worth, which we will refer to it in this chapter from a personal perspective, or the concept of equity, as we'll discuss in future chapters. So the idea is accounting is just this system and this methodology for, as it mentions here, tracking, measuring, identifying, communicating, also just understanding from a personal perspective where you stand basically from a financial viewpoint. And why is it important? Well, it's important to have this information, both from the perspective of understanding what your current balances are, but also how what kind of earnings or decreases in your net worth. How much did you earn? How much did you spend? Especially in this chapter from a personal perspective, kind of that personal finance type of concept and understanding, doing budgeting, and then also just reviewing your financial activity to see how much you're spending, how much are you earning, so on and so forth. Okay, so as I mentioned before, two of the main concepts that we talk about in accounting are what is owned and what is owed. So these things that are owned being assets, whereas the amounts that we owe are called liabilities. And as it mentions here, assets are resources a business owns or a person owns. This chapter is kind of more focused in on the personal side. And then claims of those to whom the company owes money. Creditors are liabilities, or in the personal context, things like credit card amounts, like I mentioned before, a student loan, maybe an automobile loan, maybe you have a mortgage, so a loan that you took out to purchase a house. And then on the asset side here, we have, cash, maybe in a checking or savings account, contents of home. This is the personal perspective, so we're thinking of things that you actually have in your house, like TVs and whatever type of furniture, etc. Automobiles, house, the value of the house that you own. And so your assets and your liabilities here are, again, what you own, what you owe, and then kind of from more of a theoretical perspective, typically, we have this concept, again, of net worth. And as we can kind of represent it here, this idea of net worth is really just taking your assets minus your liabilities. So I say theoretically because typically when we're analyzing this, it's not necessarily from the perspective of the individual. If from a personal perspective, the individual liquidating these assets, getting all of this cash, and then paying these liabilities off. I mean, that could happen. That in certain instances, if the individual or the business, if a business was to be liquidated, basically all the assets sold, so you get cash, and then all the liabilities paid off, you would have a leftover amount. This is what's referred to as net worth. Typically, though, as I mentioned, it's more of a theoretical concept because, for example, if you are an individual, maybe you're living in your house and you're using your automobile, so you might just understand what net worth is from a, like I said, theoretical perspective. But this amount of $32,000 doesn't necessarily mean you have $32,000 sitting in your bank account. It just means if you were to sell all of your assets and get cash and then pay off all of your liabilities, what would be left over. So it's a pretty handy concept to keep in mind, just to understand where you stand, from a personal perspective or from a business perspective. If you were to sell the business, for example, you might use this number as at least a starting point to understand how much equity or net worth the business has. I'm going to move past some of the quiz questions here. So we'll dive in a little bit closer on the balance sheet. Again, we talked about assets, liabilities, and net worth quite a bit, so we'll move on from that. I think we already touched on all these concepts. Now, I will say, and we'll come to this eventually here, typically there's a really foundational equation in accounting called the accounting equation, and it is represented as assets equal liabilities plus equity or plus net worth. And so you would have assets on this side equals liabilities plus net worth. But this is rewritten a bit, and I think it is a little bit more understandable when it's rewritten. You're just moving the factors around, doing a little bit of algebra to represent this as net worth equaling assets minus liabilities. So net worth equaling assets minus liabilities is the same thing as saying assets equal liabilities plus net worth. If we added total liabilities to both sides of this equation from an algebra perspective, it would represent the typical accounting equation. But from a conceptual perspective, to understand what net worth is, this is a good way to think about it. Okay, so we're going to talk about financial statements here, and we're going to begin with the balance sheet. And so we've been talking about these concepts of, assets, liabilities, and net worth. Again, they're all the amounts of the things that we have, and one key thing to think or to remember when we're talking about a balance sheet is that a balance sheet is as of a point in time. It's essentially a financial report that if we were, we have to identify what's the specific date in time, usually the end of a month or the end of a year. But it could be at a specific point throughout, in between those time periods as well. The key thing is to remember that a balance sheet is at a specific point in time. So in other words, if we were to understand how much cash, if this was $10,000, it would be as of that date. Maybe at the end of the following month, our cash balance has decreased down to $8,000 or something. And so when we're talking about a balance sheet, it's always at a specific date. And essentially it's kind of like if you were to log into your banking website, right, and you would see a balance there, that's just your balance at that specific time that you accessed your bank's website and checked. And so very similarly, when we think about a balance sheet, it's as of that point in time. And like I said, it's typically on a month-end basis. With accounting, we usually kind of separate all the activity up into months. But you could also have it as of the end of the year, etc. But regardless, the main takeaway I'd like you all to remember is that the balance sheet is just as of a specific point in time. And at that, and basically what we're saying is at that specific point in time, how much cash did you have? How much prepaid expenses did you have? What was the value of the contents of the home, the automobile, the house? And then on the liability side, how much did we owe? How much was left in our mortgage? How much for other loans? And then that idea of net worth just basically being the difference between the two. If you, again, liquidated your assets to get cash out of all of them, use that cash to pay off your debts, then you would end up with a leftover amount, which would theoretically be, that's your net worth essentially. And then again, this is how the accounting equation is typically written, not assets minus liabilities equal net worth, which is conceptually helpful and helps to understand what net worth is. But instead, it's typically written in this manner, where you have assets on one side and then liabilities and net worth on the other. And the reason we do that is because one of the primary concepts in accounting is that we balance. The equation it always makes sense. So if you have $100 in assets, then you would have to have some combination of these amounts to equal 100 as well on this side. And so you always will balance or have the same amounts on each side of the equation here. And that's a really key fundamental part of our work when we do accounting, is that we account for things on both sides of the equation so that we always remain in balance. And we'll practice with that as we go. This is just kind of a rewritten version of a balance sheet then, so you can see all the assets, and it's got the details here, so again, you could total those up, and then here's the liabilities, the assets, and then the net worth, basically being the difference between the two. And so then if you add liabilities and net worth, you see that you get 142,000 on both sides. And this would, again, back to our equation, we'd add 142,000 on both sides, and that would make our equal sign there true, or in other words, we are in balance. Okay, let me go through here. I'm not sorry, this not sure what that text box is trying to represent. It's kind of just in the way. Okay, so one idea that we want to convey is that assets, there are not necessarily just cash amounts, right? I mean, we think of everything from a perspective of dollars when we are listing out amounts here. So you can see, the house is maybe worth $250,000, and that is the value of the asset that we would have on our records here on our balance sheet. But that's different from actual cash that we have available. And so you could imagine a situation, and I think that's what this is trying to indicate. There's a wonky little extra PowerPoint in the text resources. Sorry about that. But you could have here they're showing a negative cash balance. Maybe you're overdrawn out of your bank account, but you still have a positive net worth, right? So even though, because the value of your house, your car, all these other things exceeds the value of your, the amount of your liabilities, you could still have a positive net worth, but you don't have any cash. And that's kind of a precarious position to be in, because selling your house or your automobile or the contents of your home or your investments is not necessarily something that you want to be. Maybe you don't want that at all. You need a house to live in, you need a car, so on and so forth. So the idea of net worth is not, it doesn't necessarily mean you have $120,000 in the bank, right? That's different from cash. And there are situations where you could lack cash, but your house, maybe it went up in value quite a bit, so you've got a lot of equity, or you pay, net worth, essentially same concept. So this is it's good that you have the assets here to potentially sell to keep servicing these loans that you have. But typically, individuals, you would not necessarily want to find yourself in this position, because being forced to have to sell your house or your car to be able to pay off your loans may not be something that you are desiring. Okay, let's just click through our quiz questions here. And let's talk about the income statement. And so So we've talked about the balance sheet. Remember, that's a financial report that lists out what are the balances of all the assets that you own. What's the cash value, the monetary value, basically, of all the assets you own. What is the monetary value of all the debts that you owe? So assets are what you own, debts, liabilities are what you owe, and then net worth is just like the difference between the two, essentially. And so that's the balance sheet. Now we're going to move on to the other primary financial statement here, called the income statement. And the balance sheet and the income statement are really the two primary financial reports. There's other ones as well that we'll talk about, and there's other ones behind it just that exist. But the two really key statements here are going to be the balance sheet and the income statement. So as we've already mentioned, the balance sheet shows the balances of our assets, liabilities, and net worth. And now the income and it's as of a point in time. The balance sheet, is at the, maybe it would say January 31st or December 31st or whatever, the end of that month, for example. So here, let's see an example. Let me just go back and you can see as at December 31st, 2018. So this is on that day. At the end of this day, we had $50,000 in cash. The next day, that balance might change. Maybe a payment went through on January 1st of 2019 or something. So it's really only at this time. This is just the ending balances of all the assets, liabilities, and net worth. Now, the income statement, to compare to that, is not at a point in time, but instead it basically is kind of a roadmap, if you will, that showed how much you earned and how much you spent over a specific time period. So let me say that again. So the balance sheet is as of a point in time, but the income statement is over a period of time. And so when you're thinking of a balance sheet at the end of 2018, for example, that we were just looking at, and then we could also think, maybe that was last year, and then say this year is, 2019, just to say a year later in this example. Though you could have two balance sheets at those 2 year ends that are different, and then our income statement for that whole year would basically tell us, okay, over that time, how did we go from 2018 to 2019? How did we get changes to those assets and liabilities and net worth? And that's what the income statement is going to represent, essentially, right? So maybe here's an example of this. Maybe at the end of 2017, let's say, for example, we had $10,000 of net worth. And then if we were to assume that this was the activity for 2018 over the whole year, our surplus, or the amount of revenues, our revenues exceeded our expenses. And so now we've earned an additional $6,500, for example. So if that all just was cash that we earned, then our cash asset balance at the end of that 2018 potentially, increased by $6,500. So it really just the income statement is just, like I said, sort of a roadmap that shows you, if you were to, and then maybe from a personal perspective, it's kind of answering the question, where did all my money go? I know that's a question that a lot of us have, especially if you're not keeping close track of your finances. It's hard, you're thinking like, oh, I know I'm spending money on things, food, and all these other things they list out here, insurance, maintenance, rent, etc. And so the idea of the income statement is to help us understand what went out the door and, what came in. And it doesn't necessarily have to be a cash perspective. I mean, typically that is the most common way that, assets and liabilities and net worth change is from receiving cash or paying cash. But we'll kind of dive into non-cash type transactions in the future. And really what I want you to focus in on is just that this surplus would basically lead to an increase in your assets, essentially. And that would also be an increase to your net worth. Remember that we're talking about two sides of that equation. So, so the income statement, we're going to summarize revenue and expenses over a time period. Again, very important, over a time period, not at the time period like the balance sheet. And as I was kind of alluding to, the way that the slide describes it here is that the income statement helps us determine the change in our net worth over a specific period of time. And net income, or when we're thinking about this from a personal perspective, we use the term surplus or deficit. A surplus being when your revenues exceeded your expenses. A deficit would be when your expenses were not covered by your revenues, and it'd be a negative amount. But when we're talking about it from a business perspective, and maybe something you're maybe more familiar with, we use the terms net income or net loss. So more so, like I said, in subsequent chapters, when we pivot to more of a business focus away from personal, these are the kind of terms that you're going to hear more often. And then this slide essentially just shows us how there's different types of income and revenue. You can think of revenue as a term. Maybe you've heard income. We just said net income, but that's the idea: is what is it that we're earning? It's increasing our net worth. And then from a personal perspective, the costs of day-to-day activities, and it could be when we pivot to a business perspective, the cost of running a business. The idea here in the personal is kind of like the cost of being alive, I guess, or owning certain assets. Depreciation would be a reduction in the value of things like your automobile or your house, for example. Food expenses, just buying groceries, paying rent, having insurance, paying car insurance or other types of insurance, paying for utilities, so on and so forth. So hopefully that is relatively clear. Okay, so now when it comes to the topic of accounting periods, I alluded to this when I was describing the fact that we typically see a breakout of financial activity and in our accounting records or our reports by month. It's pretty typical, but also by year. It could be by quarter, it could be 6 months. So there's no set requirement necessarily that accounting information has to only be presented in a month-to-month format or in a year-to-year format. But most typically, when you're doing this type of accounting work, whether that's for a business or for yourself, I think that you would most likely separate your accounting activity that you're recording into monthly periods, right? At least for myself, I think that makes kind of the most sense, right? A lot of our expenses are on a monthly basis. And so if you were to create your own personal budget and start tracking your own income and your own expenses, etc., I think you would probably use a month-to-month basis and say, what is my budget for August or September going to be, essentially? So whether we're doing that for personal or from a business perspective, that same kind of logic applies. But not only from a month-to-month, you do usually aggregate the whole. You will typically in accounting, we'll do monthly accounting, but then we aggregate. That will kind of be aggregated at the end of the year so that we can look and see how did we do this year, essentially. What's our balance sheet show at the end of this year? And then we can look at our income statement and say, over this whole year, again, balance sheet at the end of this year, income statement, what did we earn and what did we spend over the whole year? How did we get from last year to this year, essentially? And it talks about some of the advantages of doing these accounting periods in this way of having a year or 6 months. Quarterly is somewhat common in the business world. Some of the advantages, you track regular monthly living expenses. Often those are, monthly, as it mentions here. So rent, cell phone, similar for a business, you have similar monthly expenses. And it allows you to look and say, you kind of know what to expect every month. And so if you have an expectation of what those monthly expenses are going to be, it allows you as the accountant or the analyst or the business owner or whoever it is that's using this information to more easily know what to expect. And if something is out of whack, a bill is a lot higher or is lower, or maybe you didn't receive a bill for a certain month, it makes it easier to identify those situations and maybe resolve issues that might come up. And also it allows you to budget and forecast going forward. If you know what your regular expenses are, then you can say from a personal perspective, it allows you to do things like budget for the future. So that's kind of what's captured here in these, controlling errors. If something looks off, you're going to catch that more easily. And then assessing realistic expectations. Another way to say that is just to budget and forecast, realistically. And then this is just showing kind of the more like, this is like a quarterly perspective. You could say 3 months of activity of income statements would lead us to a net worth that's at the end of March, if we were to say as at, whatever it is, March 31st or I'm not the best with the which day, if it's a 30th or 31st, so I apologize if there's ever a time where I use the wrong date. But when I'm saying that, a date such as that, it's always like, what is it at the end of March, basically, right? So hopefully that makes sense. Okay, I'm going to skip over that concept for now. Okay, the accounting equation. So this is what I was mentioning before: assets equal liabilities plus net worth. This is the basic accounting equation. Rearranged, again, that could be net worth. How would we do that? We subtract liabilities from both sides, just kind of algebra 101. That would make this liabilities go away, and then this side of the equation would be assets minus liabilities equal net worth. So that's how we rearrange that to get that form of this equation we were talking about previously. But this has to, this equation and is really the underpinning of all accounting, whether it's for your own personal financial, your personal finance records, or for Amazon or Walmart, the biggest companies in the world, basically, right? Google, anything. And here are the assumptions that underlie this, that each transaction has at least 2 entries. So if assets are going up, then we either have to have liabilities going up or net worth going up. So that's, there always has to be 2 impacts. And we'll work with this quite a bit in different problems in class and in the homework that we work on. But just remember, there's always 2 entries, and it can be assets. It doesn't have to be assets goes up, liabilities goes up, assets go down, liabilities go down. It doesn't have to be any specific. It could be all within assets. So if you buy something with cash, in essence, one asset, cash, goes down. The other asset, whatever it is you buy, say it was a car, maybe you bought a vehicle with cash. One asset goes down, cash goes down. One asset goes up, the vehicle amount, if you were to have a vehicles account. And so it could all be on one side of the equation in one of these categories, essentially. You could think of this as for every action, there's an equal and opposite reaction. I'm not sure if that's super helpful, but there's definitely the idea there's 2 entries. It's called dual entry accounting, extremely important. And if you don't do the dual entry accounting and your equation no longer balances, then you've done something wrong, basically, and your records will be off. So we won't balance then if we're doing things wrong. One common representation of this concept is kind of a scale and keeping us in balance, right? So if we have assets, for example, on this side, again, maybe it's made up of different types of assets: cash, vehicles, a home, so on and so forth. Is that all add the monetary value of all those things is $122,000. Whatever it is on the other side of the equation between liabilities and net worth has to add up to that $122,000. So you can see here they've represented that as you have $80,000 in liabilities that you owe, and then the difference between the assets and liabilities, or your net worth, is $42,000. So you have to maintain balance. If you add these together, it's 122. So it's like, check, we're in balance, right? And if you're not in balance, this equation doesn't make sense. You can't say 122,000 equals 100,000 or something. Okay, sorry, my video skipped a little bit there, but just to wrap up that concept and make sure we put a pin in this. So just the core concept, there always has to be at least 2 entries. It could be more, but you always need these entries to maintain the balance in this accounting equation. So very fundamental concept, and we'll do a lot of practice with that. So it's a little theoretical, probably, if you're new to accounting, that you may just be like, what the heck? How does this all work? And I assure you that we will do lots and lots of practice with that. It's really the underpinning of the entire course and just the underpinning of the whole concept of bookkeeping and doing accounting work, essentially. Okay, so here's an example of how we would do some of the transactional accounting work here. So in the accounting equation section here, we're saying if we received $3,000 of cash, it increases your assets. And if we were to only record the increase in cash, you would see that now, and we're starting from that 122,000 spot. So, but if we increased cash by 3,000, that much cash comes in, and you only increased cash, now you're out of balance because you still have 122,000 on the right side, but now you're at 125,000 on the left. So instead, you need to increase your net worth by 3,000 in this instance, with the cash going up by 3,000 on this side of the equation, and then net worth going up on this side of the equation by 3,000, which then maintains that balance. And now we're on 125,000 on both sides. So one of the tools that we use to kind of represent this balancing is this idea of a T account. And we call this these T accounts because they're kind of shaped. They're shaped like a T here. You see the, I guess, the body of the T, and then the top part goes across and down. And it's a T accounts are a kind of a, yeah, just like I said, a way to visualize the increases and decreases and to ensure that we are still balancing, essentially. And there's a left side and a right side to a T account, right? This is what we're taught. We're going to record information in either the left side or the right side. And depending on whether we're talking about an asset, a liability, or net worth, whether those things are going to increase or decrease, it depends on what category of type of account we're talking about. So if it's an asset like cash, it's going to increase on the left side. But now here, and we break down net worth into expenses and revenues, which also have their own increase and decrease on different sides. But if, again, we're going to go back to that last example of saying $3,000, so we would put that on the left side of cash going up, for example, and then we would record a net worth increase, really it'd be a revenue increase as a component of net worth, and we would put that on the right side. And so you can kind of sort of see there, that's sort of this whole idea of the balancing of the scales, the left and the right. We see assets going up, for example, by 3,000 on the left, and if it was a revenue that we earned, and that was what led to that 3,000, we would have the increase in net worth on the right side. So the right side would say 3,000, the left side says 3,000 with this T account, and we can see that we balance essentially that way. Okay, so here's a little example of a breakdown of some activity within a specific T account. Here, on the last slide, we talked about the main categories, and all of the subcategories like cash will have this same, all of the assets will have the same increase or decrease. So all assets will increase on the left, decrease on the right. All liabilities will decrease on the left, increase on the right. So opposite, and so on and so forth. Okay, so let's do a little work here or look at this T account. So here on getting started with our T accounts, we're going to record the opening balance of the account in the appropriate side. So a lot of times unless you're, especially from a personal financial perspective, it's hard to really imagine a time where you would begin. Maybe some point is when we're growing up, when we open our first bank account, I guess, and we start earning money. So, the time that you leave your parents' house, I suppose, is that opening moment. But more so from a business perspective, it's easier to understand this concept of an opening balance. For example, say you started a new business and you just began operations, essentially. That would be like an opening balance for the very first time. Then in subsequent periods, usually when we're saying opening balance, that's going to represent whatever the amount of that account, whether this is an asset in this instance, what the balance of that asset was at the beginning of the accounting period that we're talking about. So if that's month to month, then that's going to be the beginning of that specific month that we're talking about. And the accounting information always rolls forward. So let's just theoretically assume this was February's activity that we're looking at here. And if we said that at the, we had all this stuff in increases and decreases in cash throughout the month, and then we ended with a balance of 4,400. I think I said it was February, right? So if we assume this was February, we started with $1,000 at the beginning of February. Things happened. Cash went up, cash went down, for different transactions occurring. And then we ended with a closing balance at the end of February of $4,400. So our cash has increased by $3,400. Then this ending balance, again at the end of February, for example, would then become the beginning balance in the subsequent month of March. So 4,400 at the end of February would become the opening balance at the beginning of March. And the whole process basically would restart. So there's always this continuous, there's continuity in terms of the accounting information over time. And the subsequent month's closing balance becomes the next month's beginning balance or opening balance, essentially. Okay, let's get through there. Okay, so now we're going to talk just a little bit about accrual-based accounting. And when we're talking about accounting, so far, we've been kind of thinking of this concept of cash and earning cash and paying cash as being revenues and expenses, right? That, over that time period, essentially. But one concept that's really important to understand is this idea of accrual basis accounting or accrual based accounting. And what we mean by this concept is that we want to record revenues, again, an increase in net worth, or expenses, a decrease in net worth, in the period in which they occur, regardless of when the cash payment is received or paid. So another way to say that is, even if we have a utilities bill, for example, that comes in at the end of January and we owe that money, it's a liability. Even though we haven't paid it yet, we're going to want to make sure that we record that expense for that utility usage in the month of January. So we're not going to see cash go down. We're going to record the expense in January, for example, but we would record an increase to a liability because we would owe that amount, as opposed to recording a decrease in an asset because we haven't paid it yet, right? When we do pay the bill in the future, we will decrease an asset and decrease that liability. But the really important thing is just to kind of divorce your thinking from revenues and expenses having to be related to cash coming in or out. That is that under accrual-based accounting, that is not the case, right? It's really just, did you earn the money, regardless of whether you got paid yet or whether you paid that bill? You are going to record the revenue or expense related to those things in that time period. So really just separating the ideas of cash flows in and out from the idea of revenues and expenses. And we'll practice with that a lot. It's an important concept, very important concept. So again, they're noting that cash flow relates to cash flowing in and out of the bank account, but that is not necessarily directly connected to net worth. What we're talking about here is the accruals related to net worth. So cash flow, you might do some work. Say you own a business and you complete a big job during 2024, last year, let's say, and it took you a whole year and you did all this work and you finally finished at the last day of December 31st, and your customer that you were working for owes you $10,000 or something, or $100,000, whatever it is. They owe you some amount of money, but they haven't paid you yet. And so even though they haven't paid you yet, maybe it's going to take them a month or 2 months to pay you. Even though they haven't paid you, you're going to record that as revenue in that 2024 year, which will increase your net worth. And then later, when you get the actual cash flow coming in, you'll record the cash increase. But until the time that you're paid, we're still going to record revenue, even though they haven't yet paid you in 2024, but you would still record the revenue in 2024. And really what we're trying to do with that concept in this accrual basis accounting is trying to get the revenues earned in the right period, because cash could be paid. Maybe the customer has some issues and they don't pay you for 5 years or something. Maybe it's some long drawn out legal case or something. There's a whole list of reasons maybe that the cash could come quite a bit later. But we still want to understand that the amount of work and the amount of revenue that we earned was in 2024, even though we don't have control over exactly when the customer pays us necessarily. So we'll practice again with that, but just keep in mind that we're going to don't think about revenues and expenses as a function of cash coming in or out. That would be cash basis accounting, which we don't really do in this course or other courses in college level accounting, essentially. That is a method that some businesses can use, and you can use on a personal basis, is that you only record your revenues and expenses when you actually get the cash or pay the cash. But for our purposes in this course, we're going to focus on accrual basis accounting, where again, we're recording revenues and expenses in the period that they are earned or expenses are incurred, regardless of when the cash is actually eventually paid. And we'll practice. I think practicing with that concept, because it's a little tricky, so I'm going to skip over the examples here, because I think doing some hands-on work in the homework and in class is going to be important there. Okay, let's talk about the concepts of borrowing money and repaying debt. So again, this is just getting back to kind of our basic accounting equation here. And the idea, that we have assets on one side and then liabilities and net worth on the other. And so if we borrow cash, for example, we would see an increase in our cash. I mean, that's pretty inherent in understanding, I think, pretty self-explanatory. We would also see, and so we get the cash. Say we borrow, say we borrow $10,000 for I don't know, for whatever, personal loan. Let's just keep it simple. So you go to the bank, you say, I need to take out a personal loan. They just say, okay, and they give you $5,000, $10,000, or whatever it is. And then they give you that money. So obviously cash goes up in your checking account. Maybe slightly less obvious, but hopefully still pretty obvious, is that you owe that money back to the bank. They didn't just give it to you as a gift. They gave you the money, and now you have a liability to repay the bank. And then alternatively, when you pay the bank back, you're going to decrease that unpaid account or that personal loan or whatever it is, and cash will go down because you're paying off your loan, you're giving them the money back, and then that liability will decrease or maybe go away depending on if you pay off the whole debt or not over time. But there is the concept, remember, of interest, usually, that a bank is going to charge you, or a credit card, or whoever you're borrowing money from. Typically, the reason that they let you borrow that money is because you're actually going to have to incur some expense. And so there's going to be additional amounts you pay on top of just paying them back that original amount you borrowed, which is based upon some percentage interest rate, essentially. So we'll practice with that a bit more in future chapters. But I think the key concept to keep in mind here is just that when you're borrowing money or repaying money, it's not necessarily affecting your net worth, because you're really just having assets and liabilities go up or down by the same amount. And those are on the opposite sides of the accounting equation. And until you incur some sort of expense related to interest, typically, you're not going to have any reduction to your net worth. And you don't get an increase to your net worth by borrowing money either, because it's not your money, right? That's the whole idea, is that if you were to borrow that money and then turn around and go give it back to the bank, it would basically just zero out that transaction. You're not, that money is not yours. It's the bank, and they're just loaning it to you. So you have a liability that you have to repay. Again, we'll practice with that as well, but just keep that in mind. That's a common situation, whether it's personal or business focus. We touched on this a little bit already, buying and selling assets. And so there's no, buying or selling assets, for example, doesn't have an impact on net worth again, because we're really just exchanging one asset for another, essentially. So it's kind of a weird way to think about, buying stuff or selling things, but that's essentially what we're doing. Is if we have another asset, we exchange cash for a vehicle, for example. Those are both assets, cash and the automobile. And they have this, the automobile will have the monetary value of the amount of cash that we paid for it. So when we decrease cash by $10,000, we just increase the other asset account by $10,000, the automobile account, and they essentially just kind of zero themselves out, so there's no impact on our net worth. We've just exchanged one asset for another. And then in that, buying something. Selling something, just the opposite. If you have a vehicle you sell for $10,000, you get $10,000 of cash. You haven't earned any additional net worth because you just replaced one asset with another. So one went down and one went up by the same amount. There's no extra net worth. You haven't increased your worth at all. You're just trading one asset for another, basically. Okay, let's move on through the questions there. And again, I know there's a lot in this chapter, and we're touching on a lot of concepts that we are going to spend a lot of time on and dig into detail in later chapters. But this really sets the stage for a lot of the concepts that underlie all the accounting work that we're going to do throughout this entire course. So it's really just kind of an overview of things. So keep that in mind. Hopefully don't, try not to feel overwhelmed by the information that's being provided here. This is essentially the entirety almost of the entire course, just an overview, and we're going to do deep dives and lots of practice on each of these concepts. So if it doesn't exactly make sense as I'm going through these things now, that's really to be expected. And I hope that from watching this lecture, it just provides you with sort of a starting point of understanding. And then we're going to, like I said, do deep dives on all these concepts and make sure that you get the information really dialed in. Okay, so let's talk about prepaid expenses. An example, typical prepaid expenses would be for things like insurance, or maybe you prepay your rent. Definitely insurance, though, I think is one of the most common, especially from a personal perspective, whether that's homeowner's insurance or car insurance in this example. Typically, you do pay the full amount of that insurance up front. So say you paid, here in our example that we're seeing here, we're paying 6 months in advance. So maybe it's $100 per month, but you have to pay $600 on January 1, for example, if it was 6 months starting in January. And so you prepay that full amount. And again, so it's not, I want to back up to, let's back up here. So let's say I think it's a little easier to conceptualize this idea of trading assets one for another when you're buying a car, because an automobile is very tangible. It's in the driveway. You can see it. Cash is gone, but you have an automobile now. But in a similar fashion, so a prepaid expense is also an asset, just like an automobile. Even though you can't touch it necessarily, it's just you've bought this service essentially that if something goes wrong, you're going to receive payment from your insurer. But it's not tangible like an automobile, but still you have something. You have this and so you're prepaying those 6 months. And so each month you will decrease that prepayment. Say it was $600 on January 1. And when you paid them that full amount, they said, okay, we'll cover you for the full 6 months. And so at the end of January, you're going to decrease that $600 prepayment by 1/6, because it's 6 months, remember. So 1 month is gone, and you've used up basically 1/6 of that service. It's 1 out of 6 months. And so you'll recognize $100 of insurance expense at that point, and you'll decrease this prepaid expense by $100. And then over the next 5 months, it'll continually go down by $100 each month, because that prepaid expense asset is in essence being used up, if you want to think of it that way. And here's an example again, similar. You paid $1,200 for insurance coverage for the whole year, and then 1 month of coverage has been used up. And really, when we say used up, really when something like an insurance policy, it's really just based on time, right? So as 1 month goes by, that's it. That's, in other words, it's quote unquote used up, right? Because you have only 11 months now covered, and they're kind of showing this in their little picture here, where you can kind of think of like 1/12 of this is going away, and when you get to the end of the 12 months, the whole thing has been, you're not covered anymore, right? At the end of the 12 months, and typically, if you continue coverage, then you have to repay a whole year's worth again, and you just do this over and over again. Similarly, you could prepay for things like a gardening service, $600 per year. You pay in advance. So prepaid expense, another way, if you want to think of it as payments in advance, that's kind of the same concept there. And then as those services are provided, whether that's over time period, which typically it is, or some other means, maybe you're prepaying until a specific, maybe you pay for renting a venue or something. It doesn't have to be 6 months, 12 months, and every month it goes down by 6 or 12 or whatever. It could be that you prepay to rent a wedding venue or something, and then you don't recognize that expense until the wedding happens. So it can be based on one specific incident, like a wedding occurring or something to that effect. But the idea is really that if you've prepaid, you've paid in advance, you have an asset now that can be used. It will be used up at some point in the future once you get the thing that you're paying for. And again, it gets back to this idea of accrual basis accounting. And the reason we don't record all the interest or the insurance expense here let me get back to that. We don't record $1,200 of insurance expense just in the first month, because that would violate the accrual basis accounting rules, where we want to put the specific expenses into the specific months, right? And so if we did $1,200 of expenses in January and then none for the other 11 months, that wouldn't split out or spread out the expense accurately based on the actual contract, right? Because you're paying for 12 months, just paying it in advance. So that's kind of the idea, spread out the expenses appropriately. Okay, let's talk about the concept of capital. So capital is any amount that increases your net worth, but is not earned and therefore not considered revenue. So revenue, again, is things like salaries, if we're talking personal revenue, or income, a business selling its products or services, for example. But sometimes you could receive a gift or winning a lottery, for example. I guess when we're talking about personal financials, that is some examples that make sense. Maybe receive a gift from your parents or something. If you're tracking your own financial information and your parents provide you with money, to support your life, that's not necessarily revenue because you haven't earned it, but it still increases net worth because you do have the cash. So cash does go up. So we need to record an increase to net worth, but we want to differentiate that from revenue, which is increases to net worth and cash earned. So it's not earned, but it is received, I guess, if you want to say it that way. So it's received but not earned. That's called capital. So here it's saying, ending net worth is our beginning net worth plus a surplus or a deficit, right? So, and we could break this out to say capital is really, or sorry, net worth is really equal to the revenues that you earn minus the expenses that you incur plus any capital that you, any gift that you might receive or other things. So just differentiating, revenues versus capital. Okay, so we already talked about T accounts quite a bit. Let me see if there's anything we want to dive into on this. So we already talked about, the decreases on the left, the increases on the right. Those will differ based on whether it's assets or liabilities. The increase will be on the left, and the decrease, increase on the right, decrease on the left if we're talking about liabilities, the opposite from assets. And that's kind of just the why that is because of the idea of the balancing and the accounting equation. It's a little bit theoretical, I know, and I don't want to spend too much time talking about this because I think the best way to learn that and to get comfortable with this whole notion of how the T accounts work and the increases and decreases is just to actually dive in and do those. So we're going to have a lot of problems in the homework and in class assignments that we will work in there. But there is a process to working with the T accounts. We can talk about that quickly. What we're going to do, we're going to enter opening balances if there are any. You saw that here, opening balance. Then you're going to enter both sides of the transactions. So this is all the transactions, basically increases or decreases to cash. Then you calculate up the totals, and then you calculate whether what side has the increase. So we could see we had increases of 6,500 plus an opening balance. So if we add all these together, you get 7,500. You've got $3,100 of decreases, and then you basically just take the larger minus the smaller, and we end up with $4,400 as an ending balance. And again, I don't want to spend too much time just talking through that whole technical process because it's very much a part of the homework and in class assignments. So, all right. So yeah, chapter 1's a little bit, I can understand if it feels a little heavy or it's kind of like, the whole drinking from a fire hose type of thing. But again, take a breath, know that all these concepts are very much, and this is just very much an overview of all these concepts that we're going to do a lot of work in. And you should not, I don't expect that at this point you have a great understanding of all these concepts. This is just kind of an introduction to them. And all of the work that we're going to do and you all are going to do is going to cement these concepts in your mind and make you into good accountants. But yeah, overall, we talked about the purpose of accounting being to measure financial activity. We talked about the balance sheet being as a point in time, and it's basically recording the monetary value of all the things that you own, which are assets, and also the things that you owe, which are liabilities, and then what you are quote unquote worth, your net worth, essentially how much leftover assets would you have if you paid off all of your liabilities, and it's all on a specific date. And then contrast that with the income statement, which reports revenues and expenses for a specific period of time. So for a year, for a quarter, for a month, so on and so forth. Whereas the balance sheet is on a specific day. What is the monetary value of assets, liabilities, and net worth? And again, when we're talking about accounting, we break the information, the work that we do into accounting periods. And usually we're talking about things like months, maybe quarters, or years. But typically we have an accounting period that we have to separate this information up into. The accounting equation is assets equal liabilities plus net worth. And all transactions must be recorded in a way that ensures that we're always balancing, that this equation always makes sense. Whatever happens on this side, if something's changing here, there has to be at least two entries that ensure that this equation still balances or is accurate. Accrual basis accounting is, remember, the idea that we're going to record revenues and expenses when they happen, when revenues are earned and when expenses are incurred, regardless of whether the cash is received or paid. So we can earn revenue from providing services, but maybe we get paid 5 years later. So regardless of the fact that we get paid 5 years later, we're going to record that revenue now because we are owed it. It is owed to us now. Same thing with expenses. If we owe amounts now, we're going to record that expense, even if maybe we don't pay that bill for some period of time. We talked about debts and assets, borrowing money, repaying debt. Remember, there's no effect on net worth because it's really just our assets going up. But the only reason those assets are going up is because our liabilities are going up by the same amount. When someone loans us money, they expect to be paid back. So it's not that we're worth anymore. Our net worth hasn't increased because, again, back to that idea of assets minus liabilities, if we were to pay off that debt, our net worth would just be zero, right? Prepaid expenses, remember, those are paying for things in advance, like an annual insurance contract for 12 months. It's an asset. And then over the time period that it's used up, if it's something like an insurance contract over 12 months, then we just slice off 1/12 of that asset over the 12 months and take that to expense. And at the end of those 12 months, that asset will go to zero. And then capital is different from revenue, where revenue is amounts that you earn that increase net worth, but capital is receiving assets. So, and differentiate this between borrowing money, right? Because when you borrow money, you have to repay it. But capital would be you actually increased your assets. You didn't earn those amounts, but you also don't have to repay them. So it does increase your net worth in that instance. And then we talked a little bit just about T accounts, and we'll have a lot of practice with that in our homework and our in-class exercises. So with that said, that brings us to the end of the chapter lecture. And like I mentioned, it's a heavy chapter with a lot of concepts. So take a deep breath. Know that we're going to dive into all of these concepts in much more detail throughout the whole course of the semester. And subsequent chapters, we're really going to start diving into these topics. So this is really just more of an overview. So, all right, everyone, thank you so much. And I look forward to seeing you all in class. Hope you all have a nice day. Bye.